Citizens of the world, welcome back to another Keep Yours podcast where we try and keep a few dollars in your pockets. This week we are continuing our discussion on economics, and I wanted to first follow up from the last podcast that we did where we talked about free markets and your freedom to choose. And there's a great New York Times article that I just read on China and the intentional detention of Muslims, which we know has been going on for a good while. But the Uyghur Muslim population in China basically doesn't subscribe to the same ideological philosophy as the traditional Han Chinese. And the government has basically decided that we're going to change that because we can, because it's a communist government and they get to choose. So they're rounding these people up and sending them into camps. And until they acquiesce, which is basically what China does with every dissenter, they're going to stay in jail. And they've spent a lot of time and a lot of resources to roll this program out. And there's lessons here on freedom and, to me, capitalism, democracy, freedom all intertwine. And the lesson here is that if we allow laws from any religious institution to be put upon others, then what we do is we open ourselves up to those laws being flipped around on us when it's not the same religion that we subscribe to. For example, I think the easiest example here in the United States right now, where we're supposed to have separation of church and state, and that's the explicit reason for it, because otherwise, if one church becomes involved and in charge, well, what happens when the other one does? And you get flip-flopped, and that's not the way that government's supposed to work. It's not supposed to be based off of what we individually believe. It's supposed to be based off of what's the best collectively for all of us from a government perspective, and we're supposed to have the freedom to choose what we want to believe and not impose upon others our beliefs and not have others' beliefs imposed upon us. So if we look at that in context in the United States, what's an easy one right now is women's rights. Does a woman have the right to choose? And what we really see here is that it's you have the religious people who believe that in the sanctity of life and that a woman should not have the right to choose what to do with her body. Now, whether or not that is actually true and said from God is a religious question. And either you believe that or you don't. But in America, you're free to choose to believe it or you're free to choose not to believe it. But if we impose anti-abortion policy on everybody and we make it illegal to get an abortion today, who's to say that the prevailing religion and the prevailing religion of those who we elect doesn't change over the next 100 years? And if we can prevent somebody from having an abortion today, who's to say that a different religion can't get in charge? Say the green religion, because the green religion may say that we need fewer people on the planet and God wants us to live in harmony with the world, so we need fewer people. So what if that got imposed and now they say instead of being anti-abortion where you're not allowed to have one, we're going to force abortion on women? Because if you can have one, you can have the other. So freedom of religion and freedom in general requires that none of us, whether we believe that abortion should be a right or whether we believe that abortion should be illegal, that's a belief. And we should allow everyone to have their own beliefs. And if we enforce one, then you better be prepared to have the other enforced upon you. If you impose upon others and you force them into something that you believe, then they can just as easily flip that over and enforce that upon you. And that's what's happening right now in China. So as we continue to talk about freedoms and how that works for all of us, please keep in mind that our freedom, your freedom to choose what you want, your freedom to protest one way or the other, those freedoms, if you take them away from others, they can be taken away from you. Okay, now to get on with this week, we're going to follow up on last week's conversation of economics, and this week we're going to talk about market cycles and debt. And this is very important because we're dealing with this right now. So when the next crash comes, and I'll call it a correction and not a crash, Don't say you weren't warned and don't understand, because these are the tools for you to understand how it works. So we'll go back to the basic economics, and we know that productivity drives long-term economic growth. So my ability to get more things done means I'm worth more money. I get paid more money, more things get done. I can train other people to get more things done, or I can create systems that get more things done. All those things are great. Once I can make more money and I've increased my productivity, which increases company profits, then the company can get more credit to grow more because it's got more income. Right? So typically credit is a factor of income. So if my income rises because I became more productive, then I can get more credit. Pretty simple, basic concepts that make sense, and this is how a business grows. So for businesses, when they take on debt, it's the same thing. More productivity, more profits, more credit. This is normal, real economic growth. So if I start a bakery here and it's very successful, then I'm going to want to open a second one. And to open the second one, I need more money. So I go and ask for more money. Well, they say, how are your profits? Oh, great. And I've implemented these three things, which has increased our productivity, increased our profits. So instead of making $10,000 a year for this bakery, we're making $50,000. And the bank goes, oh, wow. Well, we can loan you a lot more money if you make $50,000 a year on each bakery and you want to keep opening more. So you get to open more. If you've made no improvements and your current bakery is not making very much money, then the bank's not likely to loan you money to do the next bakery. And this is just simple economics. This is how it works, right? So when credit is turned into debt and not used for further productivity increases, so I loaned you more money and you didn't use it for those things. You used it to put money in your own bank account. You use it to pay shareholders instead of make improvements, instead of buying more equipment or investing in people and process. You're just giving it to shareholders. So eventually that creates debt that's not supported by the business, and there's no more increase in profits. Then losses occur. Once losses occur, people get scared to lend. There's less credit, and we end up with a downward cycle. And this thing perpetuates itself. So let's take this on a personal level. Let's say that you become more productive at your job, 50% more productive, and you make $100,000 a year. So the 50% increase in productivity, and we're assuming you get to work for yourself, so you get all your productivity increases to make it real simple to have this discussion. So you improve your productivity. Let's say you find different apps that make it easier to send out all of your marketing emails, and you work with somebody to develop a program that processes your orders quicker, and you have done investments into your inventory to mean it that you carry less inventory. All of those things culminating in you going from making $100,000 a year in your little business to making $150,000 a year. So you go to the bank and you'd be like, hey, I'm now making $150,000 a year. I'd like to borrow some more money from you. And the bank goes, oh, okay, that sounds good. But instead of using that money to improve your business further and either expand it and or make more profits again by investing in productivity, you decide you're just going to go buy a bigger house, buy a nicer car. So that's what all the money goes to. But a bigger house and a nicer car doesn't make you more productive personally. And that same thing could happen with a business. So what if the business, instead of, buying more tooling, they just go, well, we'd all like nicer office space, so we're going to spend money on a super fancy, nice office. Sounds nice, but potentially all of those things, personally, and you buying a bigger house, you buying a nicer car, a business buying a bigger office, right? If you're running this bakery and you're in 1,000 square feet and the bakery runs just fine, can you expand it and take up 2,000 feet? Sure. Do you get any more productivity out of 2,000 feet? No. Do your costs rise? Yes. So wait a minute. You've increased your costs without increasing your productivity. That's a bad use of debt. So if we talk about the financial Great Recession, as they like to call it. I just call it a great bubble correction, because if we look at what happened with credit in the 2000s, and it was really just pushed by credit. So people were issued, basically, if you wanted credit, you showed up, especially for buying a house. You showed up, you said, I want to buy a house. I said, okay, how much money do you want? Huh? I can get however much money I want? Yeah, how much money do you want? I'd like $500,000. Okay. Here's $500,000. Buy the house. And then you come back a week later and you go, okay, I'd like another $500,000. I'm going to buy another house. I go, okay. Here's another $500,000. Buy another house. So what went from, oh, hey, we're going to extend people more credit, quickly turned into debt. Now there's a lot of people with a bunch of money to spend, not because they've actually earned it, but just to spend it. So supply demand says that the price of the houses go up because everyone can buy a house. Everyone can buy multiple houses. So how many houses can I buy? Well, okay, then everybody's in the market to buy the next house that comes on the market, instead of it should be the 10 people that actually have the money to buy the house because they've earned it and they're slowly working their way in. It's no, everyone's available money. But what are they going to do with it? Doesn't matter. They believe that it's just going to go up 20% next year anyway. So they're not buying it because they're actually going to utilize it. It's not a good use of debt. It's not increasing any productivity. They're buying it purely on speculation. But speculation drives prices way up. And then what happens when everyone finds out that this is all that's happened? It's not real demand. There's nothing, somebody always coming next. Boom. Credit stops. And the bubble bursts. And that is exactly what happened before. So if we start understanding how money flows, how credit equals debt equals cycles, then we can start understanding why these economic cycles exist and how they're perpetuated. So that's the prior crisis. And that's the cycle of markets and the cycle of debt. So how much debt is there? Consumer debt, home mortgage debt alone, we've got $9.4 trillion. Okay. Car debt, $1.2 trillion. Now, there was an article recently in the Wall Street Journal that said 33% of buyers in 2019 have negative equity in their cars. So before I did a podcast on it's not what you see, it's what you own. So not only do the people driving around these used and new cars, 1 out of every 3, not only do they not own that car and the bank owns it and they owe 100% of what that car is worth, they owe more. They're underwater. That's a staggering number to me because, again, cars aren't increasing our productivity generally. They get us from A to B. It's their job. A nicer one, still A to B. Student loans, $1.5 trillion. That's a huge problem because, in general, a lot of those loans are not improving productivity. They're just not. People think that they're a necessity, but they're not. And we have a whole huge section on student loan debt and how to stay out of it because it's not improving productivity. You're seeing people 30 and 40 years after college still paying off student loan debts, and that's when they weren't as much. You're seeing bankruptcy filings increase for these people, but you can't get rid of it in bankruptcy. So you're seeing more and more people default on their student loans, 1 million people a year. And while many of those people graduated with did not graduate, there's plenty that did. And those numbers are staggering. Credit card and other debt, another $1.5 trillion. So total household debt is $13.86 trillion. This is according to the Federal Reserve of New York, who publishes these things about twice a year, I believe. That's 10% more than in 2008. We're going to get to how much we want to look into that because we go, okay, well, the economy's grown since 2008. And we're going to talk about that in a little bit too. But first, let's talk about corporate debt. Similar to consumer debt, all-time highs. The type of corporate debt is what really matters and what we really want to talk about because similar to the last bubble that burst in 2008, it was based off of way too much debt for way too much credit given into the housing market. We have the same type of thing in there's good debt and there's bad debt going on in the corporate world. So again, when debt is used for productivity investment, debt can be a great tool. Adds jobs, adds capacity, improves long-term profits. But when it's used for paying shareholders, leveraged buyouts of companies, or used just to pay company shareholders, that's not increasing productivity, so that's bad debt. Total non-financial corporate debt, more than $15 trillion. So the difference is some of this is good, some of it's bad. How do we differentiate? Here's a nice graph that shows non-financial corporations carrying slightly more debt than just before Great Recession. The issue in here is what we're going to come to on how it came from, where it's coming from. So then we got to talk about our government, because they got lots of debt, especially our federal government. And this is the one that's really frightening. Currently, the federal government itself says they have $22 trillion in debt. In 2005, that was $5 trillion. Or in 2000, it was $5 trillion. Just to give you context of how much it's grown. So in 15 years, we've tripled our debt. And because of that, just like you do if you're an individual and you take out too much credit card debt and all your money now you're paying on interest expense, the government's got the same problem. So 9% of the federal budget goes to interest payments. In a few years, we're going to spend more on interest than we do on national defense. And we spend a lot on national defense. Unfunded liabilities. It is estimated for Social Security, Medicare, and all of the government employees that the federal government has over $100 trillion more that they don't even tell us about. So the $22 trillion that they're showing us now, that's debt they've already issued. That's on paper done. But government accounting is different than corporate accounting. Government accounting allows the government. So let me back that up a second. In corporate accounting, there's this principle called matching. And that principle says that I want you to match what you owe with what you're earning at the right time. So for example, if I'm General Motors and I have 40,000 employees and I'm promising them that when they retire, we will pay benefits for them, then every hour they are working, we expect them they are going to work 30 years. We expect they'll work 2,000 hours a year. So we'll expect 60,000 total hours. After they work those 60,000 hours, they're going to retire and we're going to owe them probably, let's just say for conversation, $1 million of retirement benefits at that time. But to make it real easy math, well, let's say it's $600,000 in benefits for 60,000 hours worked. So for every hour somebody works, there's $10 in future benefits that needs to be. And realize these are not real numbers. I'm making this up as I go. So I'm just trying to make it so you can put it together. So in corporate accounting, every hour that person works, if I expect I have to pay them 10 at retirement, I put that on the books as an expense. Not that I'm paying today, it's a future debt owed. So I would say, okay, the expenses for right now are I have to pay this person $30 an hour now. I also need to accrue, i.e. show that I'm going to owe it in the future, $10 for their retirement. And therefore, I'm now showing, hey, I have this long-term payment that I have to make. In government accounting, they don't have to show that. So they only have to show what I have to pay this year. So over the next 20, 30, 40 years, according to some people, they're going to have to pay out another $100 trillion. Here's the kicker. Total federal revenue is about $3.6 trillion right now. So if we look at that from how much debt do we have currently, as you would. So if you personally make $50,000 a year and you have $400,000 of debt, it would take you spending no money in 8 years to pay off. That's where the government's at right now. We're at like 7 to 8 years of if we spent nothing to pay off the debt. Well, we know we're not going to spend nothing. So how are we going to pay off this debt? I don't have answers for that one. Neither does your Congress. So what about state governments? State governments actually collectively are in pretty good shape. There's a couple that are in horrible shape. For example, the metro in New York is so far underwater they could never raise prices enough to get out from under it. How they're going to pay for that, your guess is as good as mine. But I'll tell you who's probably going to end up paying for it, whoever owns the stock of the Metro Transit Authority, because that stock ain't going to be paying no dividends for a long damn time because it's broke and it's going to be broke. So whoever bought stock in that, they're going to end up eating that. Bondholders, probably the same thing. I mean, in theory, there's assets there, but you have to be able to run them all. It's such a big operation. California is also in a ton of debt, not surprising because they like to promise everything, build bullet trains that go nowhere, and impose a ton of laws on their own citizens that make no sense. So that is what it is. But overall, compared to the federal government, they owe quite a bit. Now, where they do owe money that's going to affect you and me is the same as the federal government. So if we look at the federal government and we say, hey, look, there's $100 trillion owed here, and we've got another $6 trillion for the states, that's basically for the same stuff, except for the federal government owes pension liabilities for all of us who are paying into Social Security and Medicare. The states owe it for their state employees because they don't pay into Social Security and Medicare. So if you're especially like a member of a teachers union or you work directly for a state government, your pension obligations, again, the same that I was just talking about with a company where GM might have to say we're putting away $10 for each person every hour that they work. The state should be doing the same thing for you. They just don't like paying their bills up front. So it's unfunded, and a lot of times they don't show it. Now, state accounting, they're starting to make them show this more and more. And the other reason that these numbers are all guesses is because how much the state owes is based off of how much the state expects to make every year on the money it currently has put away. And that's their expected rate of return. And of course, that's always predicted and put into all their calculations at a higher rate than what the actual return is. And then what happens when the returns drop? Everything's predicted on increase, increase, increase. The same way that the housing market was predicted in 2005 of it's fine. Housing prices only go one way, and that's up. It's true until it's not. All right, so that's what I just talked about, states and high returns. So many states are still in real big trouble. And the problem that the state and federal governments have is that what are they going to do when the next correction comes? And as I'm about to walk you through, the next correction, even though our stock market just reached an all-time high again, is coming because of all this debt. So I'm about to get into one of these things that probably most economists at most universities, I have just had this disagreement with them on from day one. And there's a few of these things that are out there that I have disagreements with people on. For example, in the public accounting world, there is this belief that financial statements are audited and that the auditors are independent. However, the company pays the auditing firm. So that's like you paying me coming and doing an inspection on your house, and me saying I'm independent. It just violates the definition of independence. Independence says that I am not relying on you for any payment. But if you're the one paying me, then obviously I'm dependent. So this is my economic argument that is very similar to that. Every time there's more spending year over year, they say that is growth. But if, as in the example I gave earlier, all you did was buy a bigger house, buy a nicer car, then you spent more money. You now actually have more expenses. There's now actually, you are actually poorer for living in that bigger home, driving that nicer car, because both will require additional maintenance expense in excess of what you had before. So you make the same amount of money, you're poorer than you were a year before. Hope your fancy car makes up for that. But if we're all borrowing money and we're spending it on things that help growth, so if instead of buying a bigger house for yourself, you buy a rental property that you can then rent, and that's going to generate income to you, well, that's helping your pile of money grow. That's growth for you. But if you spend it on the things that don't increase productivity, i.e. just that bigger house or nicer car for you, then you're just going into more debt, and the economy is not really growing. We're just temporarily spending more. So if our government's spending an extra $1 trillion a year of debt, is our economy really growing? If businesses are spending money that's really debt and not increasing productivity, is our economy growing? If you and I are spending more money on nicer cars and nicer houses, but that don't increase our productivity whatsoever, then are we really growing? Or is this all one? Are these just multiple temporary expenses? And again, wait a minute. Let's go back to that government number and look at how much money that is, because that's going to matter. So over the last 15 years, and most of that is since the last big correction, $17 trillion. And our current GDP is about 20 million. So if you actually said that was over the last 12 years, then about $1 trillion a year, or 5% of the U.S. economy, is based on government spending. How much of that government spending went to increases in productivity, such as nicer roads or better ports that allow us to move more things, other things that support growth that will increase government revenue? Well, even if we had done things that increase government revenue, then Trump came in and changed the tax laws, and we're actually collecting fewer dollars in revenue, even though it's supposed to have sparked this great boom in business, which of course it hasn't, because it's just another transfer to rich people, regardless of what they want to tell you. That's what it is. That's who his real constituents are. He did not do it for poor people. When he got up and said, "Oh, my rich friends are mad at me," no, they're not. None of them are. Not at all. But you can see in here that there's $17 trillion of debt spending. How much long-term benefit are we going to get out of that? A lot of that money early on was given to people who were on unemployment. Remember they extended unemployment to 2 years from 6 months so that everyone could keep spending money and not go look for a job? They basically took the incentive to look for a job out. Now, I'm not saying they shouldn't have helped a lot of people out. That's not what I'm saying at all. Don't get me wrong. What I'm saying is none of that money went to improving productivity. So is that growth? And the economists hate this question because it forces them to deal with debt. And the reality is they don't know where the debt's coming from. They don't know overall, realistically, is that debt being put to things that are of use? And so then if you work in and with the federal government, you're going to be incentivized to say, of course it's going to increase productivity. Of course long-term tax revenues are going to rise. Of course. And if you hate the current administration, then you're doing the other thing. Oh, no, none of these things, none of these programs will prove anything. No, the truth's always somewhere in the middle, right? So have some of the things improve productivity? Maybe. Worst off, we end up with more and more laws, which makes our society more and more litigious, which makes doing business harder, which that's actually what stifles growth. But most of this spending is not improving productivity. Most of it's just not. So if most people bought nicer cars and houses, and that's how they spent their money, and most businesses distributed that money to shareholders or did stock buybacks, then we haven't spent any of this money on increases in productivity. So did our economy really grow? And they throw out numbers, but those numbers are just dollars that were spent. And they can't differentiate between spending and growth. And growth is spending that can happen over and over again. Because if I invest in equipment that makes my employees more productive, and I can then pay all of those employees more money per year because we make more money per year, then they can go and spend that money, and they'll have that additional spending every single year because the increase in productivity is there. The business will make more money every year. But if I spend that money on stock buybacks, I didn't change any productivity. I can only do that one time. Oh, and I got to pay the interest on that. So it's actually detrimental to the company because we have this debt that we now have to pay that we're not getting any additional profits for. And this is my theory that for it to be real growth, it's going to have to be able to happen again year over year over year. And it's not based off of my access to cheap debt money that I don't have to repay or don't intend to because we have to repay. If all the businesses and all the people are just buying fancier cars, the point of a car is still to get you from A to B. For the most part, it's not making us more productive. Therefore, we're going to have another correction. And when this correction comes, it's basically going to be saying, hey, the debt that got issued was supposed to be to increase productivity. That didn't happen. We don't have more productivity. For some people, that means they start going bankrupt, and that creates our next downward cycle. Because then, oh wait, they haven't been using money for productivity. Stop giving them money. Oh, we stopped giving them money. Now all that money that they were spending is not being spent. And we start into this cycle of the downward spiral, which is there's less credit being given, less people to buy, and things are being corrected, right? We can call it a crash, but really that's a correction because really we shouldn't have been spending all this debt to begin with. And slowly but slowly, people won't be able to pay back their loans. And here's the thing. When they go bankrupt, does that count against growth? Or is this when they say, oh, now we're in a recession? Because people aren't spending all of the debt money that they shouldn't have spent, that they had to spend until somebody stopped giving them the debt. How do we end up here? What are we going to do now? Well, maybe, just maybe, somebody should be looking at debt and saying this is growth or not. Maybe additional debt, depending on what it's used for, should be categorized differently and not saying, hey, this is our economy is growing, because they like to tell everyone that it's growing because it all gives us all a false sense of security, right? Oh, growth. That means our kids will have jobs and we'll have jobs. And we don't have to worry about it as much. Not your government spending more money than it should. This is unsustainable. At some point, ask Greece, and we're getting close to Greece rates. We're right behind Italy now in how much debt we have. No one seems really concerned. I'm a little concerned. So maybe they should say, hey, the government spent $1 trillion. The economy didn't grow for shit. The government spent $1 trillion extra. So there was 2.2% more spending this year than there was last year. But the economy didn't really grow that much. But they don't like to say those things. And that's what I'm saying. Depending on, are you with the current administration or are you against it? There's perspective bias that bleeds into this. And this makes it really hard for economists to try and predict what's going to happen. But these are the kinds of cycles that exactly do happen. And if we look at growth over the last 10 years, then we have to ask the questions. Is this really growth? How much of this is one-time event spending on people, governments, corporations, upgrading the houses and cars, and not on improving productivity? And unfortunately, I think the answer is a lot. In fact, I'm pretty sure of it based on all the research that I've done. So let's look at this a little bit differently. Let's suppose you are in charge of letting people borrow money. So what if you lent the money to everyone? You've got the purse strings. You can decide who's getting loans and who can't. But here's the thing. It's your money. And if you run out of it, you run out of it. Free market applies, but you get to do the lending. So how much are you going to lend to somebody? How are you going to decide how much you're going to lend to somebody? What questions are you going to ask them? What are you going to want to know about them before you lend them money. And the only caveat, if you're going to be the one lending them money, it's the only thing you do. You need to lend them money to make your own money. So you want to lend money. You're the bank. You want to lend people money. You just want to make sure you're going to get it back. What if they just want to use the money to go on vacation? What if they just want to use it to buy a bigger house? What if they just want to use it to buy a bigger car? How much are you willing to extend a person? How far are you allowed to get? Are you willing to let them get over their head in it? And do you want to know about anyone else that they're borrowing money from, so that you can make sure they don't get way too far over their head? Because the further they get, the less likelihood you have of getting your money back. How about for an education? How much money would you lend somebody to go get a 4-year degree? And would it depend on that degree? When we look at $1.5 trillion of student loans, we don't put any limits on any degree to say, well, you want a sociology degree instead of a business degree or an engineering degree. Nope. Everyone can get the same amount of loans. What happens when people that you are lending money to have more debt than they have in assets? i.e., their ability to repay you continues to fall. And remember, those assets, they're only worth what somebody else is willing to pay for them today. So let's say the next correction's coming next year, in 2020, where there are always a prediction of a recession, but then by the time we're in a recession, they told us it started 6 months ago. So that's always the clowny thing where I'm like, these people don't really know. No one knows what's going on, really. Everyone's guessing. And then when the data comes in later, they go, oh yeah, the recession started 6 months ago. I don't need you to tell me what happened 6 months ago. I know, I was there. I know when sales slow down. I know because I could feel it. Everyone feels it at their job when work slows down. You don't have to be a genius. Even you could be a frontline person who just got a job at McDonald's. And if you've been there for a year, you can tell whether it's busy or slow comparatively to normal. And it doesn't have to be on a one-day basis, but based off of a couple of weeks. How many people you serve every day. How busy you are. Oh, or slower and slower and slower. Those are problems. But what do you do if you're the one loaning people money and you loaned them $200,000 for their house, and their house is worth $190,000 and they still owe you $190,000, and you loan them $30,000 for a car, and that car is now worth $25,000, and if you had to get rid of it and go pick it up and repo it and get it sold, you're actually only going to get $20,000, and you've loaned them $15,000 in credit card debt and they've run up all $15,000. And they haven't got a salary increase and they can barely afford to make all their minimum payments right now. What happens at that point? How do you plan to get your money back? What about if you're loaning to a business? What do you want to know before you loan a business money? You can get in there, understand their business plan, know who their customers are, see what contracts they have. You can look at all that stuff. But I could have perfect contracts today. Great customer list. Doesn't matter. Could change tomorrow. Always. Would you lend money to a business that you knew they were just going to distribute to their owners and not put back into the business? Because if they put it back into the business, then the likelihood that you get it back out because they've increased productivity is much higher, right? But if they're just going to give it to the shareholders, and then if the company runs out of money, you have no way to get that back from those shareholders. Are you comfortable with that? What about, would you lend them the money to buy another business? And the follow-up question is, what if you thought they were overpaying for that business? And who gets to decide whether or not you think they're overpaying for that business? So the huge use of debt in corporations is one of the biggest uses is what's known as leverage buyouts. So let's say that you've got a very successful bakery and you grew and now you have 100 of them. But because you grew one at a time, you're slowly paying off the debt. So by the time you got to 100, the first 10 have no debt at all. The next 50 have 50% of their debt, and the last 40 have 80% of the debt that you originally took out. And remember, that debt is specifically for equipment, the build out of the facility, hiring and training employees, all things increasing productivity, making you money. Company looks at how much money you're making and they go, "Ooh, we like that business. You got a really nice bakery brand. We like that. We think we have some other businesses that may fit well together with that. We want to buy that from you." And let's say your 100 stores are making $10 million a year. And they go, "We'll give you $50 million for the business and absorb. That's just what we're going to give to you, and then we'll handle all the debt that's currently owed. So everything else we take, and we give you $50 million. And if you started that business, that is the American dream. You go, "Absolutely, I am taking that $50 million. Thank you very much. I worked my ass off. I've lived the American dream. I have built a business and sold it. Hopefully they'll keep me around for a couple more years while I can help them with it because I'm the founder and I still want to be involved and I don't want to just walk away. Or maybe I do. Either way, doesn't matter. You get your $50 million and you're out." So if you look at the business now, the business has the debt that was originally associated with each place, which improved productivity, and now an additional $50 million that they borrowed the money to pay you out that it has to pay back as well. So that business could have been just fine and could have continued to operate and continue to make profits, no problem. But now it's also got to pay back an extra $50 million, right? Typically that's called goodwill, i.e. the amount over the physical assets that a business is paid for, which is basically future profits. So anytime a business is bought, if I run a business and it makes $1 million a year and you come and buy it for me and you can be like, "Whoa, I see that the asset value that you have is $1 million. So I will offer you $1 million for your business." I will look you square in the face and be like, "No, that's stupid. It's a waste of my time. Get out of my face. Why am I going to not just work one more year and still have the business and make my $1 million? Why would I sell it to you for the same million?" No. So businesses are sold as the same as stock. So when you buy a share in stock, what have you bought? A right to future cash flow. So that the earnings of the company, you have a right to. When you own a business, it's the same thing. What do you own? You own the future rights to the earnings of that business and all of the physical assets of that business and trademarks and whatever else you've built into it. When you sell that to somebody else, they're buying they have to pay you back. So this works out all the time. People sell their businesses like to their employees. And basically think of it this way. If you're an employee and your boss came to you right now and you said, "Hey, you guys are doing a really great job and I'm almost not needed around here, so I'm ready to retire. I'd like to sell the business to you guys." Essentially it'll work out like this. You guys do the exact same thing you're doing for the next 5 years. And all of you do a little bit more work to take on my job, and I take the profits for the next 5 years, even though I'm not here, and then at the end of the 5 years, it's yours. Essentially, that's the way it's working out, and the question is, how many years? How big's the buyout? How many years of earnings am I going to pay? And that could depend on if the company's still growing, and somebody else might be more valuable to them because there's different things that they can interweave with it. Right? If you're selling bread and there's somebody else who's got a cupcake factory and they go, "Well, we could sell cupcakes at your bread store and that would increase our profits even more," then your business may be worth a little bit more strategically because it has an ability to grow. But in general, that's what we're talking about here. But a lot of that corporate money gets used in these buyouts, which basically just saddles the company that they bought with a ton of debt. Now, if it works out and over the next 10 years, they pay off all of that debt, then the new owners didn't have to spend anything for it. They just made the company pay off all the debt. And now the company's paid the debt, they own the company, now they get the profits, and they could sell it again. Great. And if they have some more money to put into it and grow it and expand it, those are the things that make it work for them. But if they're just literally buying it because money's so cheap, right? Why not just buy more assets, buy more houses, just like 2006. Buy more, buy more, buy more. Everything's growing, growing, growing. Well, until it isn't. Okay. So, if you're the one lending everybody money, would you lend a business money that doesn't have any profits? Such as Uber. If I came to you right now and I said, I have a great idea. These cab companies, they make a ton of money. They make billions every year. We could figure out a way to let people use their own cars and give a ride to somebody. We'll call it ride sharing. And we'll charge way less than the cab companies do to try and drive them all out of business. And we won't have to spend very much money because we'll have everybody use their own car. Oh, that's a great idea. It's not going to make money, though. We're going to lose about $1 billion every quarter. Sure, I'll loan you money to do that. That sounds like a great idea. What's the difference between a cab ride? Oh, it's cheaper. That's right. Okay. But we're going to lose a bunch of money. How long are we going to lose money for? Well, we don't know yet. We don't know yet. Well, we know there's a path to productivity. And if we can get self-driving cars, then we won't even need people. And then we'll make a gazillion dollars. We'll be ahead of the cab companies. But in a sense, all Uber and Lyft have done is displace the cab companies. And anyone who's looked at prices recently went, oh, hey, now they're charging the same price cab companies used to charge. Seems like the same business. They say it's different. It's ride sharing. It's not a cab ride. It's ride sharing. It's the same function. I get in a car. It takes me to someplace else. I pay them to do that. It's the same function. So it's not yellow. Okay. But your business isn't making any money. So I don't want to loan you any. But if we look at this from an economic cycle standpoint, right? So what happens when you're the one who's lending everybody money and you start looking at the Ubers and the WeWorks of the world who are making no money and plenty other companies that are doing things making no money? When they started all this fintech stuff, they were like, oh, we're not finance guys. We're not bankers. We're fintech. I get calls from them every single day offering to loan me money. Same as my bank does, except for actually higher rates. So if you can't get a deal done through a bank, they'll loan you money based on your personal credit. Sometimes it's easier to get a deal done, but don't think that the rates are less or anything else. They're doing the same function. So I see all these things doing the same function, but losing money, and I'm going, well, what's the difference? I'm still getting a ride. Still, Airbnb's no different. That was around before. It was called VRBO. The only difference is Airbnb is just like a hotel, except for maybe it's an apartment complex or whatever else, but it's a hotel room. Is it better because of some amenities that I would prefer to have, like a kitchen? Absolutely. Is it increasing prices to make them equivalent with what a hotel would be worth because you can rent it every day? Absolutely. Is it causing more homelessness in California? 100%. They'd like to tell you all those things aren't true, but they are. So you're the one lending everybody money. Everyone chooses to spend that money on share buybacks and distributions to shareholders and leverage buyouts of companies and bigger houses and bigger cars. Nothing's improving productivity, which in your mind, the alarm bells start going off and you're like, well, how are these people going to be able to pay me back more and more and more money when they're not earning any more money? They're not improving productivity. Their business isn't getting any better. There's no great opportunities for growth here, but they're spending more money. So I'm concerned. So I'm going to stop lending everybody money. So what happens when we stop lending Uber that's losing $1 billion a quarter money? What happens when we stop lending WeWork billions of dollars that it needs? And when I say we, I mean financial markets as a whole and society as a whole. What happens when we don't lend them money? They don't have any money to operate. They still have losses, so they go bankrupt. And the first set of people are the people that can no longer pay their bills. So let's say in this case, and I don't think it's going to start right now from this. This is just an example. But let's say that between WeWork and Uber, they all go out of business because they don't have any more money to keep operating. And their employees get laid off. So you have the business not making its payments. So there's the first losses for people. And now you have all the employees who all bought bigger houses and nicer cars. And now they start going bankrupt. And if it's just this little subset and that's it, then the market can deal with it. We expect a certain amount of losses. We expect, a couple percent of people to, for whatever reason, then there's multiple, to not be able to pay their bills and to file for bankruptcy. But what if that then snowballs into, because those people from those companies aren't spending the money they were spending anymore, now more people get laid off. And they say that each time you really create a job, that job echo effects create 7 more. And because you spend your money and the next person spends their money and so on and so forth. And there's a theory that it's about 7 people. I don't know if that really holds true. I think that depends, and I think there's some definite limits to it. But even if it's 3, if every person that gets laid off means that, they're not spending that money anymore, then 3 more people get laid off. And this is one of the reasons we have unemployment insurance, is so that, hey, you get laid off, you still have some money. So not all those other people, if it's 7, not all of them are going to lose their job because you're still spending money on the basics. So the first set of companies file for bankruptcy, lay off employees, stop buying from other businesses. People lose their homes and cars, move in with relatives. They minimize buying to necessities. Then the second wave. Employees living paycheck to paycheck go bankrupt next. Businesses that were barely making it because they borrowed so much money in the leverage buyout, and they can't absorb these. Even if they reduce staff, they're still too big a payment on the debt. And all these customers have been lost, and now we don't have the ability to find new customers to make up for them right now. So we have to lay off people as well. More people lose their jobs. More bankruptcies follow. And the wave continues on that downward spiral. So in the same way that a rising tide lifts all boats when the economy's going great and unemployment's super low and everybody has a job and wages are growing and everything's good, when the cycle flips, and what's the other pieces of that? When everyone's making more money, then everyone's issued more credit, then everyone takes out more debt, which increasing credit then stirs more buying, which increases the economy, and we keep going on this upcycle. Well, the same thing's true on the down cycle. Everybody tightens. People don't want to buy. Everyone's waiting for the bottom. So even if you have $100,000 of equity in your house right now, you might not be able to access it. You go to sell your house. There's nobody to buy it. Everyone's scared to buy. Ooh. Well, there's already 4 homes for sale in your block, and we're waiting for them to reduce prices further. We don't know where the bottom of this will be. So until we have a feeling we're near the bottom, scared, not buying, right? So there's going to be a lot of people who have a lot of equity, and even at the end of the day when it settles, they may still have equity, but equity doesn't help you if you can't write the check this month. If you can't pay rent now, you get evicted, and that house goes up for auction, and that auction price is going to be very low to the extent that you probably lose most of what you had in the house. So if the majority of your wealth is stuck in a home, you better make damn sure that you've got retirement or some sort of money set aside where you can keep paying that mortgage so you don't lose your home. Because that's where a large amount of your money is. So the other piece that happens, again, if you're the one lending money to everybody and you see this starting, you see the bankruptcies begin, and you're taking the losses from them as well, then what do? You're not lending anybody else new money, so there's no money to go buy all those things. Everyone's scared. Until it reaches the bottom. But where is the bottom? How long is that going to take? Whew. And then are we talking about the government's got to stop overspending? Because I'm positive that as soon as there's another recession, the $1 trillion deficit we have right now will increase even more. Well, when are we going to pay that bill? I don't know. This is actually the scary place that America's gotten itself into. Of we can just keep overspending and there are no consequences. There are consequences. And when everyone's just buying a bigger house and a nicer car, those and businesses are just giving money to shareholders and doing stock buybacks and not improving things in productivity and not living within our means, when that next downward cycle comes, it's going to be nasty again. So we don't have a specific asset class where the bubble is going to burst. This is going to burst across the broader economy because there's a lot of businesses not making any money. And when the purse strings get pulled for those businesses, the echo effect will affect us all. So you can't say nobody's told you now. I'm telling you how to save yourself in the debt cycle. If we have free markets, then the customers and consumers are free to choose. That's freedom on both sides. So if you're the one issuing all of the credit, which gets turned into debt, you have the choice not to give it to people. Don't give them any debt. Similarly, it's your choice to take on debt. You have to sign. The more debt you have, the more likely it is that at some point you won't be able to pay it back. Ask yourself this question. How long do I survive if I don't have a paycheck? For more than half of Americans, that's less than 2 weeks. That's frightening. And if you own a home and have a lot of equity in that home, that's really frightening. And that's why they say you should have a safety fund. You should have some money set aside in different places. Consumerism continues to tell us we need more. We don't. The key to financial independence is actually living with less, being happy with less. My wife and I were recently at the beach, and we both just had big smiles on our face. And we were just super happy to be there because our requirements for that to be a happy place for us are not very high. A cold drink, a dip in the ocean, and warm water, fantastic. I'm happy. That's all I need. I don't need a Four Seasons resort and somebody to come towel me off afterwards. I don't need that. I'm happy with simple things. And therefore, my happiness is mine to choose anytime I want with the simple things that I have. So when we live to simplicity, then we don't have all these extra needs, which means we don't spend all that extra money. We're not going to spend all of the extra money on a bigger house and nicer cars just because we got a raise last year. Let's put some of that away. Let's save that for a couple of rainy days. Let's live within our means. Let's drive used cars because what's the difference? It's getting us from A to B. Driving a $150,000 Tesla Model X is no better to me right now than driving a Jeep. Is it green? Maybe. What are they going to do with them batteries when they're done? I got to deal with charging issues. What if I get in an accident? Who's going to fix it? Can't even get parts. And it costs $150,000. I can buy a used Jeep for $25,000. Gets me from A to B. That's all I need right now. Live within my means. Protect yourself. Save and invest. And understand these debt cycles. Understand that these are cycles of way too much credit being issued and not being used for increases in productivity, not being used for what they should. And if you know that, and you know that those cycles are coming, then you can actually prepare yourself to take big advantage of them. Here's the secret. Most people probably don't know this. And it's not really a secret in the investment world. Wealthy people. And I'm talking like Chris Rock wealthy. Like, okay, Shaq's rich. The guy who writes Shaq's check, he's wealthy. That's what I'm talking about. Wealthy people tend to keep up to 30% of their money in cash, liquid, waiting for the next downturn, waiting to take advantage of opportunities to buy at very low prices. And if you want indicators that the current market cycle has some problems in it with debt, well, I've shown you the debt numbers. We're 10% over where we were right before the last crash. Ask yourself, is that because everyone just bought something that's going to increase productivity, or did everyone just buy things that look nicer and shinier today? So wealthy people know these cycles exist. They look for the clues, and they have people who make a lot of money sitting there waiting, deciding when to move money around, but have money available. So what happens when people start going bankrupt and they can't make their car loans? What's going to happen? A lot of cars for sale. Seems like a good time to buy. Same thing with houses. It'll be the same across the board. Wait for the dip, buy in the dip. But you can't do that if you're completely extended and you owe. You're going to be the one filing for bankruptcy. And then you're going to be pissed off that somebody else came and bought your car and your house for less than what you paid for it. If you're overextended, that's your fault. It's a free market. It was your choice to take on debt each time. Your decisions cumulatively lead to that point. There's going to be opportunities. The question is, are you going to be in a position to take advantage of those opportunities, or are you going to be in the unenviable position of being impacted dramatically by those downturns? It's up to you. It's your choice. You get to choose. I just want you to know. Don't blame anyone else. You get to choose. You could be in bankruptcy, or you could be taking advantage of cheap assets. Your choice. That's what I got this week. Thanks for listening. Hope you tune in next time, where we try and help you keep a few more dollars in your pockets. Cheers.